Stephen Cress, creator of Seeking Alpha's stock picking system. Seeking Alpha, all you need to know about investing in top stocks or in anything else. Seeking Alpha, be a better investor.
Hi everyone. Today we have a very special guest. The famous quant specialist, Mr. Steve Cress, is visiting Mijun. Hi Steve, how are you?
I am very well. Thank you so much for having me on your channel today.
No, thank you for your time. Last time you visited our channel, it was back in October in last year, right?
That's right. That's right.
How have you been?
I've been very well and enjoying the roller coaster ride in our markets of our ups and downs. If you recall, in the first half of last year, we got into June, the market was going into a big correction, and then July to October, we had a bit of a rally. And then in this year, we've had a big rotation back into the mega tech stocks that underperformed so much in 2022. So it's been fascinating to watch the markets.
Okay, so you just talked about the rotation. So after this, the mega tech stocks boom, what would be the next move in the U.S. market? What do you think?
Yeah, so I actually think, since there has been so much investment in the mega tech stocks year to date, and I think that has been a result of actually investors being very defensive and uncertain on the economy. We have had inflation come down, but it still has been sticky. We've had the Federal Reserve in the United States and many other central banks continue to move interest rates up this year. So I think investors have actually been uncertain about the markets, and their result has been to get defensive, and they've invested in the mega tech stocks. At this point, I almost feel the perspective is that the Fed has been able to lasso inflation and get a little bit more control on it. And I think going forward, investors will not be as defensive as they were in the first part of this year. My expectation is going forward that we will likely see investors rotate out of the 5 mega tech stocks into the broader market. And I think this speaks very well for people who invest on fundamentals, people who look for value, growth, profitability. Many of these companies that fit those metrics have not done well because there's been such a focus on security in the mega tech stocks. But now that people feel a little bit more comfortable, we'll probably see investors resume looking for companies with good fundamentals. And I think that will broaden out into the overall market.
Oh, fantastic. That's a great news. So if I could just summarize it, so the reason megatech was good for the beginning of 2023 is because there was certain level of uncertainty still in the US market. So people were a bit afraid to go for small stocks, and that's why the investment money was focusing on mega tech stocks.
Correct.
But in your opinion, maybe now the atmosphere is getting better then?
I think, yes, the rate of change is there. So inflation is starting to come down a little bit, and it makes investors feel secure that inflation will not be running away, that the Fed does have a handle on inflation, and that they have taken rates up so much that there potentially could be a slowdown in the rate increases. And I think people are even beginning to forecast into next year at some point, rates may actually come down. So when rates start to come down, obviously that will benefit the markets. And I think investors just feel a little bit more secure now than they did in the January timeframe. And historically, when people get defensive, sometimes they'll go into fixed income instruments, government bonds. But in this environment, you've had interest rates going up. So when interest rates go up, bond values go down, and nobody wants to be in a situation where they're losing their principal. So that's why I think instead of individuals focusing on bonds for security, they went to the reliable megatech stocks instead,
I
where
see.
the return possibilities were grateful, and they've been rewarded. But now that people feel a little bit more secure, absolutely, they should start looking at companies with good fundamentals. And I think we'll start to see a rotation out of the megatech into other sectors and companies.
Okay, that's great to hear because I think then our timing for our second interview is perfect because now the fundamental matters more than before then. So we
Correct.
can pick up some nice stocks according to quant scores and quant analysis. So it's perfect timing to have a chat with a quant specialist.
I think the timing is good. I think the timing is
Amazing.
good.
Okay. Since our first interview was like almost 8 months ago, I was wondering if you could just briefly introduce yourself to our audience because I have a few new subscribers in my channel.
Absolutely. Well, my name is Stephen Cress, and I work for Seeking Alpha. I'm the head of quantitative strategy. A few years ago, Seeking Alpha bought my company, and my company created a technology where we had directional recommendations for companies being buy, hold, or sell based on a quantitative review. And a quantitative review may sound technical, but really at the end of the day, we're a fundamental investment analyst, and we're looking at companies, and we're looking at value metrics, growth metrics, profitability metrics, earnings, and even stock momentum. And from a quant perspective, what we do is we look at those metrics, but for every company, we look at that metric relative to its competitors. And that's how we score companies. So we're really using the same principles of an investment analyst, but through computer processing, we could look at it for all companies and refresh that data every single day. So I developed that company a few years ago, and Seeking Alpha really liked it, so they bought the company. For the most part, I have been a quantitative strategist or portfolio manager for over 30 years. Most of my career was spent at Morgan Stanley. I worked there for about 14 years. And in addition to that, I worked at one of the biggest asset managers in the world, which was Northern Trust. And I also founded a hedge fund. I did it when I was living in London, not too far from where you are, Charles.
Yeah.
And I ran the hedge fund for a few years. And then I also founded my investment research company, which Seeking Alpha bought. So a lot of experience, and all of it mostly revolves around quantitative analysis. And again, at the end of the day, really, quant is using the same principles as most investment analysts, but we just use the power of computers to process that information. And we can go through cash flow statements, balance sheets, income statements, financial metrics for thousands and thousands of companies and refresh that data every day. So when we bring you our opinion and you look at the Seeking Alpha quant for companies, you know every day that opinion is refreshed.
Fantastic. But it sounds a bit complicated, actually. So if it is possible, could you share your screen and then just go through briefly how the quant analysis work, how we evaluate and find the stock to invest utilizing quant score?
Absolutely. So I will share my screen now. And I'm going to go to the main dashboard for Seeking Alpha. So when many subscribers come in, they would come into this page. And this page just provides sort of the trending news on the day, which you could see on the right-hand side. And then we have a lot of contributors that write research every single day. And what you'll see under the trending analysis are some of the top stories that people are clicking on. But if you are interested in ideas, you would go over to the left-hand side, and this is our main menu bar where you see analysis, news, market data. And if you scroll down, we actually have a section that's called Find and Compare. And you could go to a stock screener, or you could go to top stocks. And if I click on top stocks, this is the quickest way to come up with ideas. You can see we provide you with a list that ranks the companies based on the quantitative score. So this is a good page to give you a summary of what we look at. So as you look at Rockway Medical or Green Brick Partners, you can see that there are a number of grades here, and the grades will range from A plus being the best grade all the way to F. But of course, since we're looking at our top rated stocks, all of these companies possess some of the best grades that you could find out of thousands of companies. So what we do is we have these core investment metrics, being value and growth and profitability. And when you see these grades, you know that this company, Rockwell Medical, in terms of its valuation, is very, very attractive compared to its competitors. And in terms of its growth, it's very, very attractive compared to its competitors. So we're ranking companies. This quant ranking rating over here has a total score, and that total score reflects these 5 core factors. So you could take a deeper dive into this. So what I'll do is I'm going to click on number 3, because this has been a very, very popular stock, Supermicro. And one of the reasons why it's so popular is it's a semiconductor company. And if you scroll down, you can find a definition on what the company does. Here's the profile. It develops and manufactures high-performance server and solutions in the United States. And they actually are a really big provider to companies that have artificial intelligence. So companies like Facebook, by example, which are heavily involved with artificial intelligence, will use this company's technology and hardware. And I misspoke. It's not a semiconductor company. It's a software and storage company. And you can see the stock has done incredibly well. If I click over here, year to date, the stock is up 172%. And you can see it's not only well scored with a quant ranking, but if you look at Wall Street analysts and Seeking Alpha contributors, they both have a buy on the stock as well. Just going to move something over so it's not blocking the factor grades. You can see in terms of the factor grades, what we look at from a quant side, that the valuation for the company is very, very attractive. Now, you have the ability, if you want to take a deeper dive into valuation, you could simply click on it. And you could see the most common ratios that people look at, PE, and we look at PE on a GAAP and a non-GAAP basis. We also look at the PEG ratio, which is a very, very important metric because that looks at a company from a value perspective and a growth perspective. So if you hover over the PEG, it will tell you what that valuation metric is, as all our metrics. If you have any uncertainty as to what that metric means, you can just hover over it and it will tell you. And in this case, PEG is the PE ratio divided by the growth rate. And that's why I really like the PEG ratio, because it combines both value and growth into a ratio. And you can see that this company is very, very attractive versus its competitors. And you could just scroll down and you'll see other common metrics such as EV to EBITDA, price to sales, price to book. And on price to book, it's rather expensive versus the sector. But you could see that with a grade, because that grade provides you an instant characterization with where this company compares to the rest of its sector. If we were to go on the growth page, we could see that this company has straight A's for growth. So whether we're looking at year-over-year revenue growth or forward revenue growth, and what forward revenue growth is, we look at a consensus of analysts that are out there taking their forward estimates. So our quant model not only looks at historical growth, but it also looks at forward growth as well. And we do that by looking at the analyst community on Wall Street and assessing what their forward estimates are for the company. And we create sort of a consensus number. So we can see that the forward growth estimate is 31% versus the sector median at 9%. Hence why it has that A grade. And the same is true for EBITDA growth or earnings per share. And earnings per share, the forward number is always very important because people want to know what earnings are for the company and what that growth rate is. And we could see the forward earnings growth rate for SMCI is 66% versus the technology sector at 10%. So it has incredible growth. If you want to see the other companies in the sector, you can simply just click on that. And this will take you right to the technology sector, and it will rank companies according to our metrics. And again, we're looking at value, growth, profitability, EPS revisions. We're scoring all those metrics to come up with that overall quant rating, and then we can rank companies based on that.
What about the profitability? Do we have any specific metrics we need to focus on out of those list of numbers?
Yeah, so as you can see, we list many metrics. And the reason why we do this is a number of our investors are happy just to look at the overall profitability grade, but a lot of investors will want to do a deep dive, and they like to look at every metric that's out there. So we provide those key metrics. But for most people, you can sort of trust that overall profitability grade. And what we do is we score all these underlying metrics. But personally, if I'm just going to be looking at a company, I want to see what the net income margin is. And that's sort of like bottom line. What is the net income margin for the company? And you can see here that it's a B+. So for SMCI, their net income margin is 8.99% versus 2% for the sector. So it's the net income margin is much, much higher versus the sector. And then I also like to look at return on common equity, ROE. So my belief is that net income margin or ROE are very important. And as you can see, the return on equity for the company is very high at 38% versus the sector, which the sector comes in at 0.5%. So the technology sector overall does not have a high return on equity, and this company has a very high return on equity. Another number that's important for people, often during periods of uncertainty that as we've been in recently, they want companies that are profitable. They'll often use the term cash is king. So they want to make sure companies have a lot of cash. So you may just want to go to cash from operations and see how much the company has overall. So they have about $647 million in cash from operations versus about $55 million on average for the sector. But also another important number is cash per share. So when you take all the shares outstanding, this really shows you, does this company have a lot of cash per shareholder per share? And here it scores very high as well. They have $6.91 per share versus the sector median, which is $1.76 per share. So those are some of the important profitability metrics that are out there. Another metric that we use at Seeking Alpha, it's the only grade that does not reflect a lot of underlying metrics, and that would be the revision grade. And with the revision grade, we're looking to see in the last 90 days, how many analysts have actually revised their earnings estimate up versus how many analysts have actually revised their earnings estimate down. So it's all sort of in that change. And in the last 90 days, we see with this company that 3 analysts have revised their estimates up and only 1 analyst has revised it down. And that's for the full year estimate. If we look at the upcoming quarter, and people, are always focused on the next quarter, we will show what that number is for the upcoming quarter too. And here you can see in the last 90 days, 5 analysts have revised their quarterly estimate up and no analysts have revised it down. So the expectation is that this company will continue to grow its earnings, and analysts feel very, very positive about the company's earnings results. And that brings me to, what we do on a quant side is if you look at the factor grades, we are bringing forward companies that are collectively strong in terms of value, growth, profitability, momentum, and those analyst revisions. And that's how we rank our stocks. So you could look at the broader stock market, or you could just look at a specific sector and click on that sector. And again, this will show you sort of the top ranked stocks based on those 5 core metrics.
When we talk about 5 different metrics, I remember last year you told us that there are different weight on each metric. So out of 5, which one is considered as the most important factor?
We provide an overweight on 2 of the factors here, and those 2 factors are valuation and momentum. And the reason why we overweight those is in an investment period that we've had over the last couple of decades, there's always a lot of focus on growth and momentum. But what happens is you can run into periods where the market corrects. And you want to make sure that you're not buying something that's too overvalued. Because if a stock is really, really overvalued, those usually fall the hardest when you go into a corrective period. So valuation is important. And being that we are looking at a company's growth and the profitability and the EPS revisions, which in a way is reflecting growth as well, because we're looking at the number of analysts that are moving their estimates up, we want to make sure that value is got a good weight. So value has a heavy weight to it, and then momentum has a heavy weight to it. And believe it or not, if you went back over the last 200 years and you looked at all like 50 different financial metrics that, you know, we consider, that's actually more than 50 financial metrics, but the most important metric over that 200-year period is momentum. And when you look at momentum, it ends up being a very good predictor of future price action. And we have found that there's a high correlation between companies that score well in momentum and how that price does in the future. Another way to think about it is people will often say to me, you know, they think that if they buy a stock that is closer to its 52-week low, that they'll do better than owning a stock that's near its 52-week high. The reasoning is, and this is false reasoning, the false reasoning is if a stock is already at its high, it's made its move, where if it's at its low, it hasn't made that move up. And the reason why that reasoning is faulty is typically whenever a company is trading near its 52-week low, they're not doing something right, okay? The business might be right, the sector might not be right, the industry or management. It's coming down to that. Something is not going well for that stock, and that's why it's near its 52-week low. If you were to invest solely on companies that were approaching their 52-week high or their 52-week low, you would do far better by owning companies that are at its 52-week high. So we look at momentum, and often the stocks that we recommend have made a pretty good run-up, but history shows that is actually a very good metric. You want stocks that have positive momentum instead of negative momentum. So that's why that has a heavy weight to it.
Buying a dip means maybe it's in general, if a stock market is going down altogether, you can buy because there are some victims. But if it is only single stock which is going down, there should be a good reason, and then it's better.
It's like it could be okay to buy on a dip if there's like a news event or an announcement, and stocks will soften up in certain periods, and that could present an opportunity. But if a stock continues to trade down and go lower and lower and lower, and it's at its 52-week low, and it keeps establishing a 52-week low, that's a problem. And I would say try to avoid those. We call those value traps. So sometimes they look to be very good values because they'll have a great value grade, but if it's not accompanied by good growth and good profitability or good EPS revisions, chances are it's at that value for a reason, and the stock may not go higher.
Sure. Great. Thank you. Now, I would like to move on to some general question about the U.S. stock market, if you don't mind. As we are all aware, the U.S. stock market has been very hot this year, and most of the heat is coming from AI booms, artificial intelligence. So what do you think about this current AI craze? Is it like a dot-com bubble, or is it different this time?